Hi, have you ever struggled with a statement of cash flows? Well, numbers often do not balance, or there is some strange balancing figure just to make it all right. And your auditors always get it right, don't they? So, how do they do it? I'm Sylvia of IFRSbox.com, the place to be if you want to learn IFRS fast, stress-free, and like a pro. In this video, I'm going to show you the basics of cash flow statement preparation. It's a very simple case study, but maybe it will open your mind and you'll get totally new approach to start with. And believe me, this is more or less the way your auditors do it too. Well, maybe they use slightly different format, but the essentials are the same. Trust me, I was one of them. Now, before we dive in, let me give you a small tip. To maximize your benefit from this video, if you watch it on YouTube, please change your settings to high definition or HD in this corner. Yes? So you'll see all the figures, numbers, and everything clearly. So all you need to get started is your balance sheet or the statement of financial position at the reporting date and at the end of previous reporting period. So in this case, 20X4 and 20X3. And you also need your income statement or the statement of total comprehensive income for your reporting period. So for the year 20X4 in this case. Then you would need a couple more information for your adjustments, but we'll mention that later. Let me stress one very important point. When you have your balance sheet and statement of comprehensive income, be careful about plus and minus signs. Otherwise, you get messed up and lost. Well, note here that the assets are stated in plus and all liabilities and equity minus. And our total is zero. That's a check. And in the statement of profit or loss and other comprehensive income, all revenues are stated in plus, and costs or expenses are minus. You can do it vice versa, but you have to remember it, right? I advise you to do the same before you start working with these statements. So let's start. First of all, we need to calculate the changes in the statement of financial position. So for now, just forget your income statement for a while. Let's play just with your balance sheet. Careful here again. The changes in assets have the opposite cash flow effect. So if property, plant, and equipment goes up, then cash goes down because you have probably spent the cash for purchasing new equipment. Changes in liabilities and equity have the same cash flow effect, not the opposite one. So if share capital goes up, also cash goes up because you probably raised more cash with issuing new shares. So if you use simple formula here, beginning balance less ending balance, or 20X3 less 20X4 balance, you will get the correct change in cash flows. You can use the same formula for assets and liabilities and equity. That's why it is so important to care about your pluses and minuses before you even start working with cash flow statements. Again, check, total of all changes should be zero, without subtotals, of course. Now, we have our changes. Each change in the balance sheet or the statement of financial position has some effect on the statement of cash flows, and therefore, each change must be taken somewhere there. Now, let's go change by change, and let's try to determine the part in the statement of cash flows where the change enters. And just put it there. Here, I drafted a blank statement of cash flows for you. Of course, you might need to delete or add some lines or rows as necessary, but as you can see, it has all three parts: operating, investing, and financing, plus the final reconciliation. So let's tackle each balance sheet change now. Change in property, plant, and equipment. It's investing part because purchases and sales of property, plant, and equipment enter simply there. As the change in cash flows was negative, it implies that companies spend some cash in property, plant, and equipment, and therefore, we put the whole change in the line purchases of property, plant, and equipment. Changes in inventories and trade and other receivables are typical working capital changes that enter the operating part. We put these changes here as an increase in trade and other receivables, and decrease in inventories. Just watch out your signs. Changes in assets have opposite effect, and that's why our decrease in inventories is reflected as plus 2,000 in our cash flows. Next, change in cash and cash equivalents does not enter to any part because that's what statement of cash flows is about, right? Instead, this will be part of final reconciliation, but this is the only exception in balance sheet or the statement of financial position. Every other change must be classified and assigned somewhere in the statement of cash flows. So we put beginning balance of cash being 4,000 euro here and ending balance of cash being 9,600 euro here. So I don't bring the change being 5,600 anywhere, although it's net increase. And instead, we will calculate net increase in cash and cash equivalents directly from cash flow statement and verify whether it's the same as the change in the balance sheet. Now let's take a look to the liability and equity side. Change in share capital enters the financing part because it reflects sources from shareholders. As change was positive, we bring the number of 5,000 euro here to the line proceeds from issue of share capital. Just don't care about the fact whether you really received these 5,000 from shareholders or it was some non-cash issuance. This is just the first step and everything else will be adjusted later. Change in retained earnings, that's operating part. As the main change in retained earnings is current year's result, we put it to the line profit before taxation. I know, that's clearly profit after tax here, yes, but again, that's okay for the first step and we'll adjust it later. Changes in long-term borrowings belong to the financing part because they represent movement of external financial resources. Long-term borrowings increased and therefore cash received enters to the line proceeds from long-term borrowings, right? So this company probably took a new loan. Changes in payables to suppliers and employees enter to operating part as increase in payables. Remember, change in the liability or equity has the same effect as the change in cash flows. Well, and we are done for the first step. Even if you have any other items, you can always perform this initial classification, and this will be great basis for your further work. Now let's check it. We have already had some subtotals in this blank statement, so then we have calculated our net increase in cash and cash equivalents as total of net cash from operating, investing, and financing activities. And as you can see, we are numerically okay. Our calculated net increase of 5,600 plus beginning balance of cash of 4,000 equals to ending balance of cash of 9,600. This completes significant basis for further cash flow preparation. If you follow these steps and assigned all changes in balance sheet to the individual lines in the statement of cash flows and your final check is okay, you're on the best way to complete statement of cash flows correctly and without headache. Now, we have to make some adjustments. Well, what kind of adjustments? Well, basically, we need to eliminate any non-cash transactions that appeared in profit or loss or in the statement of other comprehensive income. But also, there might be some other items that need to be presented separately or in another way. So what kind of non-cash adjustments might there be? For example, unrealized foreign exchange gains, losses, dividends paid, revaluation surpluses, issuing of new shares for repayment of debt, loss on sale of property, plant and equipment, and many others. I cover all this in my premium training package, IFRS Kit, available in ifrsbox.com. But let me show you two adjustments also here. When we look to our profit or loss statement, depreciation is clear non-cash item that must be adjusted. Now, we will make every adjustment in the separate column. Just don't care about subtotals in adjustments and do it like you do bookkeeping or like you make double entries. You add some figure in one line and deduct it from somewhere else, right? So, we add 2,000 euro, which is depreciation, back to the profit figure. As non-cash depreciation artificially decreased our cash profit, we have to put it back, right? And we do so in the separate line. Where's the other side of entry? Well, as it's minus, we shall treat it as adjustments to payments for purchases of property, plant, and equipment in investing part. Well, you always need to ask yourself, how was this transaction accounted for? And you simply do the reversal in cash flows. Let's make one more adjustment, current income tax expense. Although it is mostly cash item, it's always treated as separate adjustment. So let's do it. We have to add tax expense figure back to our profit in statement of cash flows from one very simple reason. In the first column, we have put simple change in retained earnings to profit figure that includes profit after tax. But statement of cash flows shall include profit before tax. Therefore, we shall add current income tax back to the first line, and the other part of an entry goes to the line income tax paid in the operating part. Well, unless you know that there is some other hidden adjustment, for example, when you paid some tax prepayments, then you might need to adjust the line where you put your current income tax payables or receivables. So your next step would be to look to any other relevant information because some non-cash items might arise also there. So what kind of information should it be? For example, statement of cash flows from previous periods might show you some interesting things that cannot be omitted. Or you just go and ask people in your company, did we acquire anything under finance lease? How did we distribute profit from last year? Alternatively, you can just take all balance sheet captions and look for changes in their movements. If you're able to explain all movements in the balances between the beginning and end of the period, then you're able to identify potential non-cash items. Absolutely crucial thing is to review the statement of changes in equity and check whether all changes have been incorporated. There are often some non-cash items that require reclassification, for example, some revaluations through equity or converting debt to equity. Now, after all this work, we can finally see the end of the road. We just add all numbers together and do the final checks. The last column in the statement of cash flows will be the statement itself. It is the sum of changes in the statement of financial position, in the first column, in all adjustments. So after we added numbers together, we can make our subtotals. And as you can see, the final reconciliation has not changed. The beginning and ending balance of cash is still the same, so the net change of it. Yeah, that's correct. All what has changed is just explanation of cash movements in details above. So as you can see, our checksum is 0 again. And I guarantee if you follow this method while preparing statement of cash flows, there always be 0 in the checksum. Then just check if amounts in your cash flow statement make sense. For example, if profit before tax in cash flows equals to profit before tax in profit or loss statements, etc. So we have just explained the method how auditors and smart accountants prepare their statement of cash flows. Of course, if you're interested in much detailed explanation with many twists and complications included, then I'd like to point you to my IFRS kit available at ifrsbox.com. If you like this video, please share it with your friends and write me a comment below whether you find it useful and whether it really demystified this hard topic for you. Bye bye and thanks for watching.